This is Roger Conrad, and I want to thank you for taking the time to watch this video. Here are 3 things I want to cover over the next 5 minutes. First, I want to share a quick update of what's been happening over the last year here at CUI. Second, I want to tell you about a brand new program that we are excited about called CUI Plus. And lastly, I want to answer the top 5 questions that I've been getting from our investment community. All right, a quick update on what's been happening at Conrad's Utility Investor in 2018 and in the essential services and utility sectors. We've had a number of opportunities to buy best-in-class, high-quality stocks at incredible entry points. We haven't had that opportunity in almost 4 to 5 years because many of these stocks have frankly been out of reach and too expensive to jump into. We've also been able to lock in gains and profits in a number of names that have reached and exceeded our profitability target levels. And candidly, that's something I never expected to see in such a short time horizon. At the end of the day, this year has been fantastic because it brings me a lot of personal satisfaction to help people break out of a prison of mediocre returns in ETFs and other broker-pushed investment plans by providing our hybrid yield and growth-focused investment strategy. Let's move on to the second item that I want to address in this video. What is CUI Plus? CUI Plus is a new program we're launching to provide what's really a much higher level and frankly unprecedented level of service to our investment community. For the first time, we're showing our customers how to precisely allocate their portfolio of essential services stocks using a $100,000 initial model that can be up or downsized to meet the individual's specific investment level. I invite you to take a tour of this new program if it sounds like it's something that you'll be interested in. So now I want to transition to our third segment of this video presentation, which is answers to specific questions that I continue to receive from across our investment community. I hope you get a lot out of hearing these 5 questions and my candid answers. First, how much upside can we expect from our utilities and other essential services stocks this cycle? I think this is a great question, and it's definitely something I've been thinking more and more about as year 10 of this bull market has progressed and as many stocks have become more and more expensive. High prices mean high expectations, which become increasingly easy to disappoint. In other words, it takes less and less bad news to set off a wave of selling. I think this bull market does have more in the tank, but probably more important than that is the fact that this is a market of stocks. And at any given time, some stocks and sectors are going to be at different phases of the cycle than the major averages that everyone focuses on. Let's take energy, for example. It's hard to argue we haven't already seen a pretty nasty bear market in master limited partnerships or MLPs. Also, in any given year, there's an 80 to 120 percentage point difference between top and bottom performing utilities. So really, at the end of the day, this is all about wise stock selection and hanging in the market. Question 2. How high do you expect interest rates to rise this cycle, and what level of yield should we expect from CUI portfolio stocks? This is another great question. I think rates are going higher, but the primary reason a strong economy is actually very bullish for our CUI portfolio stocks. And I think to the extent there's knee-jerk selling by investors, it'll be a great opportunity for us to buy high-quality stocks at very good prices. As for a target level of yield, I think if you stick to the most conservative stocks we recommend and buy only at our recommended entry points, you can still expect a yield of at least 5 to 6%. And just as important, that yield will grow at least 5 to 8% a year. If you're willing to be a bit more aggressive, we have recommendations right now yielding nearly 10%. But the main point here is to stick to the right stocks and right entry points. The only ETF I'd look at is the ProShares Ultra Short Utilities ETF, which we continue to use as a hedge against a breakdown in the market. It'll be a great source of funds for buying great stocks at rock bottom entry points the next time the market breaks down. Other than that, I would generally avoid utility ETFs. Not only do they always own the bad and ugly as well as the good stuff, But this is money mostly controlled by computer-generated algorithms. Not only do these investments condemn you to mediocre returns, but we just don't know what's going to happen to them in a full-blown market correction, when these algorithms are going to be sloshing around trillions of dollars in milliseconds. Question 4. How concerned should we be about upcoming November elections? Very, but not in the way most investors probably think. The key for utilities is always what happens on the state and local level. I'm looking very closely at a number of governors' races this year, for example, because governors are who generally appoint utility regulators. There are also several initiatives on the various ballots this year with the potential to affect utility investor returns. The good news is that because few people focus on these issues, we don't have to predict the results of the vote. We just have to know what the key issues are and how they'll potentially affect individual companies. Then we can lighten or add exposure after the votes are in, which will almost always be well before most investors will react. And finally, question 5. Is there a point where you'd recommend selling our utility stocks? We've historically prescribed 2 circumstances for selling. The most important is when a company's underlying business appears to be breaking down. That's most often revealed by consistently missing operating targets, but there can be other warning signs as well, such as a sharp deterioration in regulatory relations. Sometimes this bad news will generate selling before a company's problems become truly acute, sometimes not. Either way, we want to be out as soon as possible, whether we're booking a gain or a loss. Think about it this way. If a company is sinking at a time when the economy is growing and capital markets are as favorable as they are now, it's likely to do quite a bit worse when the overall environment sours. Several dozen companies in our utility report card universe currently rate sell. We strongly advise everyone do so now. The other circumstance for selling is when a stock reaches what we consider to be an unsustainable level of valuation. We've recommended investors take at least partial profits on several high flyers over the past couple of years. We will continue to do so as long as this bull market lasts. My view is this is a much better way to manage the end of a bull market than trying to pick out a specific point to bail out based on a guess of when it will quote-unquote end. For one thing, if you're living off your investments, you really can't afford to be out of the stock market, given the alternative is yields of 2%, if you're lucky. Well, that about covers it. Thanks very much for listening.